Hey there, Blockhead Traders. Here, Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions for. This is Blockhead Traders for the week of June 15th, 2025. And in this week's episode, Viper and I are going to take a look at a continuation of the IoT trade that Viper put on as a calendar spread. And we're going to take a look about, are all brokers really considered equal? So Viper ran into a couple of limitations with the Robinhood broker, and this past week I tested those limitations on my broker of Interactive Brokers. And so we'll see how the IoT trade panned out, and then we'll take a look at, did the brokerage make a difference? But before we hop to that, I want to give a shout out to our Discord, link in the description below. Hop in there. You can say hello to myself, Viper, some of the other Blockhead traders. Love to hear what you're trading. Love to hear what type of content you want to hear about. Also, you can find a link to thetagang.com/sprocket888, as well as /ViperXL007, where Viper and I post each and every one of our equity trades, the good, the bad, and the ugly. Last, this is available in an audio-only format wherever you get your podcasts. So look us up, subscribe, and if you can't find it there, let us know and we will get it there. But let's hop to this week's content. Viper IoT and the calendar spread. That was kind of in flux. We were heading into the expiration that week of earnings, and I threw a trade on just to see how we could do going into the money. But before we kind of talk about that brokerage comparison, how did that IoT trade pan out for you? Did it go well? Did it go poorly? Did it kind of go talk me through how that ended up?
Well, it went very well, actually. So I don't remember how much we exactly talked about in last episode, but I took, for me personally, I took what I'm starting to call my calendar condor, which is probably not a great name. I believe double calendar is what everybody normally calls it, because it's certainly not something I created. But I took a calendar spread on the call side and the put side. And day after earnings, I closed both of them for a profit. And that's when you do a double calendar like that, it seems like it's probably fairly rare that you would get both the long and the call and the put closed in profit, especially the next day. So I'm going to call that a big win. It was about a 90% profit on the put side and about a 50% profit on the call side. So not too shabby.
So when you talk about the put side and the call side, basically you're talking about the two different calendars you put on. One of your calendars was a calendar on the put, and one of your calendars was a calendar on the call.
Yes. Yeah, exactly. It's two separate calendar spreads. They don't have any relation to each other. I just opened one on the call side, and then I opened a completely separate one on the put side, and did them both at the money, and boom.
Nice. So what yields that kind of return on that as far as the price action you see on the chart? What kind of drives both of those to kind of pay out? Is it really kind of the elevated volatility, or is it just where the price ended up landing, or a little bit of both?
It's so for both of them to hit green, it's definitely where the price ends up. I think there's so many angles to it, but I think keeping it focused on the top two pieces, the top two components, I would say number one is the vol crush. And I know we talked a lot about that last week and the week before, that this was not a random ticker. This was a ticker with extremely elevated volatility. So that's number one, that the vol crush is going to be significant. And that increases the probability. And in a minute, we'll look at the chart and maybe visualize it a little bit more. And then number two is the price action of the price and where the price came back to in relation to the two strikes. So I think it's a little bit of those two things, getting something that's super juiced up, but then also getting price action in your favor, which is kind of back to that mean reversion where you started. So real quick, let's jump to the chart and maybe help visualize this a little bit more. There's a lot there's a lot of dimensions to this to this trade, and so I think that's part of why. Uh, at least I mean, I think Sprocket's in a similar boat. It's why I want to keep talking about it. Why I want to keep bringing it up because both for the viewer as well as me, very much as well as me, the more that I kind of talk through this, the more you get the different perspective, you get the different angles, and start to better understand how to utilize this strategy. But for the viewer, I get it. This could be confusing, and so the more we just kind of go through this, the hopefully the more sense it makes. So what we're looking at is the two green lines are the strikes that I took spreads on. The lines start where I opened the spread. So you can see that I actually opened these a day apart. And so some of that was just a function of the price. So this first day, you can see the price was down here. I took the $45 strike. And price was at 45.70, so this wasn't at the money strike. And then the next day, price kind of bounced up, and I was like, you know what, let's do that because we moved, decently away from the first strike that I opened up. I was like, well, let's squeeze a little more of that premium because it's now, I mean, it's still juiced, and now we'll take the opposite side and kind of create this double pattern here. So that was at least somewhat of the thinking in how I opened it, like why I didn't open them at the same exact time. And some of it was talking to Sprocket, knowing that he was about to experiment with this. I was like, well, and volatility had increased from the day to day. So that was part of it too. A little hard to see, but I mean, you can see it with this candle. This was the earnings event where we whipped up to $50 and then dumped down to $41. So volatility, I mean, the chain doesn't lie. It was pricing that in that's why, I mean, that's why volatility is so high. That's why the premium's so juicy. It was pricing in volatility, and volatility is what happened. So the thing that now to go into the profitability of both of these trades is the opening price action where we shot up from $41 and we shot right back up to $45, which is where my strike happened to be. And so for my put calendar, this is the one that cashed out at about 100% profit. This was the quintessential move, we'll call it. And there's a giant asterisk on that, which I'll touch on in just a minute. So like we talked about last week, where we showed how I was deep in the money, but still profitable on a different trade because of that vol crush being so significant. Similar and reverse for the call side. So the call side is out of the money at this point. The call side was a $47 strike. And at $45, the call side's still out of the money. But because the volatility crush was so high, and because we did have this nice move back to where I started, the call side was in profit as well. And so looking at the chart, I didn't really want to hang out. I didn't want to hang around and see if I could, play cutesy games and make a little bit more money off of this. Call side is out of the money. And so, I don't want to mess around with waiting for price to get into the money up there. So it was profit. The put side was profit. I said, let's just ring it up and let's get out of here. And I actually haven't looked at this chart since then. And so this is the first time I'm seeing the price action since I got out of there. And honestly, A plus would recommend. That was timed perfectly. And through the power of hindsight, I can say that was timed perfectly because, well, I don't know. All right. So let's just real quick. One of the things that's going through my head of yay or nay on time perfectly. This blue marker here is the short month expiration. So it looks like it's hard to tell. Market close. I guess it looks like we actually closed. I think we would have closed in the money. So $45 strike. 15 minutes before market closed, we were out of the money at 45.13. Then at market close, we dropped to 44.80. So the only reason I'm saying, okay, well maybe so had that short month expired worthless and then we dumped, I mean, that's not the plan, but that's a best case scenario because that means if that short month expired worthless, it's gone. It's out of the way. And now I'm just long a put. And so if it dumps, then all of a sudden that's ringing up profit. But that is beside the point because that's kind of one of those, that's that big asterisk. That's there's so many different ways to play this once things start to unfold. So at the end of the day, the quintessential play is to get in, get out. And this price action here absolutely accomplished that for me.
Yeah, so let me add a little bit there because I just to kind of recolor what you have on the screen. The lower line is basically your what you call the put calendar spread, and the higher line is the call calendar spread. And I think your maximum profit potential on a calendar when both legs are active is each of those lines. So if you were right on the line, that is maximum profit when both legs are active, if I understand the setup correctly.
Yeah, that's fair.
Okay, so your move basically there on that run back up to that lower line puts that put spread. That's where you rung up for your 90% of your premium you got back. You closed out for 90% profit basically. And then your other one, because you were kind of pushing towards it, and that vol crush allowed you to pick up that 30% from the other line, which is a little bit maybe atypical, but in this case, it worked out.
Yeah.
So this brings me to what I wanted to kind of talk about and see if it actually maybe would have changed your strategy at all. Now, I think you wrung out because at your broker, Robinhood, you have to exit you both legs or no legs. And Robinhood won't let you take the short leg into assignment. So you can't independently treat the two legs of. So let's just ignore the call one. Let's ignore the top line and let's just talk about that lower line. So you couldn't close just that short put.
I could close it. So I could buy it back at any time. What I can't do is I can't take assignment on. That's not a thing because it would require being short the shares, and Robinhood does not let you go short shares. So I can't take assignment on a short position, and I cannot roll the option because honestly, I don't know exactly why. I haven't dug for an exact answer, but I'm guessing I can't roll the short option because it treats it as a combined unit, as a combined play is the best. It's not satisfactory, but it's the best explanation I come up with so far. But I can always buy it back whenever I want.
So you could have bought back that independent of the long put?
Yes. Which is because they won't let me go short the shares. If it's in the money, that's what they force me to do is they'll force me to buy it to close it before the end of the market day to avoid assignment.
So did you ever click close? Does it only put in one order entry in the short order?
Right. Well, when I look at the spread, I can close the entire spread, and if I close the entire spread, then I put in a limit order, and it's gonna treat that for both options. But when I open the spread, I can see each individual leg, and I can I can tap on the short one and just buy that one back, just close that leg.
Okay, so I have a question then. I have this is not where I thought this was going to go, but this makes me actually wonder if you can actually roll it. You just would roll it manually.
So so that's to say I would buy it back myself to close it, and then I would just open a new one myself.
Correct.
Separate.
Correct.
That I'll have to experiment with that. That does seem possible. I mean, because at any point you could sell a put. Um, and so if I'm basically selling a week out, 2 weeks out, whatever expiration I pick, I'm basically selling that put in the money. But it's not expired. So yeah, I think that might be the way to get the roll situation worked around. Um, and the other thing would be if I open these up separately instead of using, because when I open these, I'm using Robinhood has this position builder thing that lets you put them both into one order. I mean, I guess a lot of brokerages do it, but Robinhood caters it to the beginner or to be like, hey, here's all your stuff. So if I open them individually, then certainly I think I could roll it like anything else. But taking assignment is definitely off the table.
All right, so let me give you feedback then on interactive brokers and my experiment with assignment. So just like you, I went ahead and set this up, and I did a double just to make sure that one of my legs was going to go into the money to test what would happen. And so what we wanted to do was figure out, was this going to consume more buying power and margin or things like that. So what I did was I went up to expiration. I was in the money on my put side. My strikes were higher than yours because I entered differently. But either way, I was in the money on what would have been your lower number. And on my broker in my UI, I can click on the calendar spread and I can tap either leg, and either leg I can choose to roll, I can choose to close, I can do whatever I want. Now, I didn't want to roll it because we wanted to see what happened on assignment. So remember, in this spread that we're talking about, we're counterweighted, right? That long put is on the same strike as the short put. So if we do a quick refresher, that means because we are long that put, we can put 100 shares to an individual. If we were short on that put side, we would have somebody else can put shares to us. Now we did this kind of on the put side, so it wouldn't have gone short shares. So I think you could have taken assignment on the put side because somebody would have been putting shares to you and you would have had to buy them. But that's okay, because what I want to call out is how much margin did that cost me? How much buying power did that cost me? In interactive brokers, I did have to pay $4,800. My strike was at the 48 strike, and it's 100 shares. So I had to pay $4,800 to own those shares that were put to me. Now, what's important is I was also long the 48 put as well. And that 48 put means I can put shares to somebody else for $48. So the broker takes a look at that and says, well, you've got this and you've got a counterweight. So you know what? I don't need to collect any money from you. So on paper, it says I paid $4,800 for them, but it didn't subtract any of that from my buying power because it knew I had a coupon that if I ever needed to, if those shares went to $5, right, I could still turn around and put those shares to somebody else for $4,800 and it would be a wash. So that was the big experiment. We didn't go short on the call. Sorry, I didn't go in the money on the call side, so I couldn't test that short, but I'm very confident my broker would have let me go short. The key point is the margin didn't change, the buying power didn't change. So when Viper sets up this maximum loss scenario in the previous episode, what he paid for the calendar is the max loss you truly can have, assuming that you don't do the wonky stuff that goes on in Robinhood, where they will just close your one leg and then leave you naked on the other leg.
Yeah, for sure. And it's weird because uh I don't know what, and I guess at the end of the day it comes down to what you're comfortable with. So the most important thing I think out of all of this is understanding, like we always say, understanding the mechanics of what you're doing, understanding what is happening under the hood so that you that's part of your risk calculation. And I think that's the most important takeaway, because which one's right or which one's wrong or which one's better or which one's worse, I I get why the situation that I face is not uh desirable to a lot of people. Um but at the same time I also don't know. I don't know. And so my confliction, if I kind of explain that a little bit more, is if we jump to this chart real quick, um, because this is this is the one that we talked about before. This is the one where everything came to a head, where I realized that, Robinhood does what it does. And so again, this was a call side strike. It was $10 strike. We breached the hell out of it, and we expired, $2.60 in the money up here. Um, so what ended up happening is I got forced to buy back that short month, and then, like I talked about in the previous episode when we looked at this, the worst case scenario exactly started to play out, where that long option now bleeds extra loss that was not accounted for in the initial loss calculation. But I am long, and on a 2-month time frame, I am long that position. And so in this particular case, as time goes on, all of a sudden, boom, like we rocketed up here. And I closed this thing out for far exceeding my quote unquote max profit scenario, because the play broke apart the way that it did. So the only thing I wanted to call out here, though, was had I rolled that short month, then my expiration would have moved a minimum to 1, 2, 3, 4, 5, 6, 7 days. It would have moved, a minimum of a week out. Um, and, you know, depending on how closely I monitored the position, it could have not been great. Like if I was still sitting on, if I had rolled it a month or something, like if I rolled it further, again, that whole counterweight situation, this price starts going up, and now I'm just holding myself in counterbalance and nothing's happening. Like both values are going up in intrinsic value, and just nothing's happening. So why even have the position open at that point? Um so I mean, I guess that's kind of a mess of logic, but
Yeah,
it's kind of
I think
what I'm kind of
leave that chart up there
working
for a second, because I think the real call out here is you're spot on earlier when you said, I don't know if this is good, I don't know if this is bad. And it's not. It's neither good nor bad. It really just depends on, your tolerance and your strategies. And what I think is the difference is your broker limits the number of choices that you can do in different situations. Not by much, but by a little bit. Because in the one trade that you have up there, if you would roll, and I always usually when I'm in the money, I recommend only rolling for a week at a time. Don't ever take big rolls, because what you want to do is just roll enough to be right, right? And all you're really looking for is rolling far enough to pull that out of the money enough so you can close it out. And so when you did that roll, I think you would be monitoring it, and you'd have an exit price that says, oh, as soon as I can get back some of this intrinsic value. Because remember, as it takes that nosedive shortly after you got, bought the thing back, forced to buy it back, that's all intrinsic value that's going to come out of that option. And so while the extrinsic value probably won't change a ton, it will change some. You're going to get more premium from the roll. Two, if you bought it back on that dip, maybe a few days before expiration, you could have gotten significant chunks of that back and still had that long exposure on the other long option that you had. And so I think the real takeaway here is you just have to know, and you didn't know, right, going into that. And that's where, what does your broker allow you and or forbid you to do, so that when you get into these situations, what are your options, for har har pun there. But
yeah. And honestly, so back to your point of turning this into a manual role, what I might try in the future is instead of like if I know 3:30 comes around on Friday of expiration, they're gonna sweep through and they're gonna force all the closes out. Um, so come 3:20, 3:25, I could just go in and sell next week's expiration. Like, so exactly what you said, but instead of worrying about closing out the current one myself, just at about the same time, know that they're going to do it. So just go collect some premium that's going to cover what they're about to do to my account. And then that kind of keeps that unexpected loss in check, I think.
Yep, I think so. I think that's another approach to take it. And then the flip side of all of that is the other limitation that you can't be short the shares. So if you ever got into a position, and I don't know that you ever would, like some people are never comfortable being short shares. Some people might not want that, and if that's you, then that limitation doesn't matter. But I think just knowing that limitation, I think would have been good for you.
Yeah, and that is that is by far. I mean, so there's a lot of things that I like Robinhood for that serves my needs that other brokers don't. But the entire time I've been there, the one thing that really bothers me is the fact that you can't go short because in a risk mitigated and a risk tolerance way, I'm very comfortable shorting shares, especially when the price action says now's the time to short. So that does bother me, and that is a big limitation to Robinhood that a lot of people need to know. And so that's why when we were talking about what's going to happen to this, and you alluded to that exact thing, well, you'll just go short the shares, and I was like, oh, okay, cool. Wait a second. Well, I knew couldn't go short shares, but I didn't know that was the result. That was so yeah. It's why we learn in public here.
Yeah. And if you really think about it, I don't want to knock one broker over the other, right? People have different preferences on the vehicles that they drive. Some have adaptive cruise control that, senses the car in front of you. Some just has old fashioned cruise control where you set the speed, right? There's just different feature sets. And some other features in those things are more appealing to one customer over another customer. And well, that's why all those brokers exist. If one broker was just terrible, nobody would use it. They wouldn't exist.
Yep. I mean, in my head, I was equating it. I used to brew beer a lot, and so I was equating it to around the time that I stopped brewing beer was when all of these push button things started coming up. These little appliances you put on the countertop, and like you buy these basically giant Keurig pods that you put in there and push a button, and you get beer that comes out. But I would brew it the manual way. I would go through the whole thing, and like this felt a lot like that. Of like, do both make beer? Yes. Do both make enjoyable things? Yes. But it's all about your personal taste and how much control you want to have over that, and why it can be worth shopping around a broker. But also don't be intimidated by these differences, because if you're not sure what you need to do is have skin in the game and just start, like, let the limitations find you. You should be aware of what you want to do. Do your research to see if they'll let you do it. As long as they let you do what you want to do, jump in to any of them. And when you start to find those limitations naturally, then you start to make additional decisions. You don't plan for limitations that don't affect you in your current state, I'd say.
So that brings us to the end of this week's episode. And as we alluded to in the very beginning, are all brokers created equal? No, absolutely not. There's differences on each one, and your mileage may vary. And it's really important for you to kind of understand what is important to you, what feature sets are important to you, and then go with what matches that the best. Now, fun fact, these days it is super easy to pick up and open a brokerage account with any broker. Many of them don't even require a deposit to open an account there, because one of the big differentiating factors is, what does the UI feel like? How easy is it to do your research? How easy is it to do this, right? How much of this kind of full service stuff can be there? And a lot of that stuff you can experience for not even putting any money in a broker. And then, even then, with all the electronic wire transfers and bank account linkages and instant fund availability, it's so easy to transfer money into different ones. And so, I encourage you to experiment, look around. And there is no right or wrong answer for the broker overall. There is a right and a wrong for you, an individual, but only you will figure that out based on your trading preferences, based on your trading styles. So really the lesson of the day is to go out there and experiment and tinker, put skin in the game, as Viper says, because that's really when your learning is going to stick. You can follow a lot of paper trading, you can follow a lot of YouTube videos, you can read a lot, but a lot of times what's really going to make that real, tangible, and stick in your brain is the actual experience of doing. So the calendar spreads working out well for Viper so far. He's really starting to dial that in. We'll keep tabs on that strategy as we move forward. And, good luck out there. Have fun. And remember, think outside the block.